The balance sheet is used by investors to not only look at how well a company is handling its assets and its liabilities, it's also used to see the overall health of a company. Yo, what's good to all my young investors, and welcome back to the channel. As you guys may have already seen from the title, I'm about to put you on game with one of the fundamentals when it actually comes to analyzing or researching a stock: the balance sheet. It's something that I honestly think that every single investor should have a thorough understanding of. And I know it can feel a bit confusing and complicated at first with all the numbers and the terms that we have to deal with. But I promise you guys, it's not too bad once you get the hang of it. I like to keep things simple and understandable, not just for me, but for you guys as well. I promise you that you're gonna have a much better understanding of the balance sheet by the end of today's video. So, explaining the balance sheet is gonna be a two-parter. I'm gonna explain to you guys what the balance sheet actually is and what the terms on the balance sheet actually mean. That's part one, which is today's video. And part two is gonna be me showing you guys what I personally look for on the balance sheet as a dividend growth investor. That way, you not only get an idea of what the balance sheet actually is, you get to see it in action afterwards. And so, before I hop into today's video, I wanted to ask you guys a quick question. What is a better passive income investment? Real estate or stocks? Let me know what you guys think down in the comments below. And so, with that being said, get a notebook, a pencil, and let's get into the information in today's video. So, first things first, what exactly is the balance sheet anyways? The balance sheet is essentially a document that shows you a company's assets and its liabilities. Most importantly though, a balance sheet actually shows us how a company's handling its assets and its liabilities. And I want you guys to write that down. A balance sheet is essentially a document that shows us how a company's handling its assets and its liabilities. And to find a company's balance sheet is quite simple. There's actually several ways to do so. One of which is going straight to a company's website and going to their investors section. And once we're there, we're going to be given two options to see the 10K or the 10Q. The 10K is a yearly report of the company where you can find the past year's financial documents, including the balance sheet. Or you guys can always go to the 10Q where you can see the balance sheet from the past quarter, or in other words, the past 3 months. What you can also do, which is what I find myself doing mostly, is going to websites like Yahoo Finance or Seeking Alpha. All you really have to do there is just type a company's name and then go to the financial section where you're given the ability to see things like the income statement or the balance sheet as well. It's a pretty straightforward approach that also works. And a good thing to note, you guys, is that every balance sheet has an asset section, a liability section, and a stockholders equity section. So, next up, what is the balance sheet actually used for anyways? The balance sheet is used by investors to not only look at how well a company is handling its assets and its liabilities, it's also used to see the overall health of a company. And you guys can think of this as a checkup. Once or twice a year, we personally have to go to the doctor to get checked up and see if everything's looking good. The exact same thing goes for companies that we're investing in. The balance sheet essentially allows us to check up on a company to see if it's doing okay, to make sure that they're not doing things like taking way too much debt to handle. So that's what a balance sheet is used for in a nutshell, to basically see how a company is handling its assets and its liabilities. And the reason why the balance sheet is so important is because it can be a huge indicator as to whether to buy a company or to sell it. In real life, for example, we don't really want to invest our time into people that are always negative and always have something bad to say. That same sort of thinking goes for companies. We don't really want to put our money into companies that don't have any cash to cover emergencies or have way too much debt to handle. And the balance sheet lets us know just that, which is huge, especially when we're in the middle of researching a potential company to add to the portfolio. I mean, at the end of the day, these are actual companies that we're putting our money into, not just ticker symbols. So now that you guys have a good glimpse into what a balance sheet actually is, let's get into important balance sheet terms and what they mean. And on a quick side note, once you start to learn these terms, you'll start to notice that a lot of things will start to make more sense when listening to things like the financial news, for example, and really anything that has to do with the stock market in general. I really recommend you guys take notes on this section too. So, the very first term that I want you guys to know about is cash and cash equivalents. Cash and cash equivalents is a company's cash and things that can be turned to cash fairly quick, like short-term bonds and stocks that a company owns, for example. Companies, just like people, need to have cash for emergencies. And this section lets us see just that. And this is a big one that I personally take into account when I'm looking at companies to invest in. So, moving forward to number 2, accounts receivable. Accounts receivable is money owed to a company by other people or other companies. And you guys can actually find this one on the receivable section on the balance sheet. And I wanted to hit you guys with a quick example of accounts receivable. Let's say Adidas orders shoes from Nike on credit, and as a result of that, Adidas has 90 days to pay the money back to Nike for the product. That future payment is now considered an account receivable for Nike on their balance sheet. Accounts receivables are huge because it's essentially more cash coming back to a company. Now, this is an important one that I personally always look into. So, next up, inventory. Inventory is a company's products and goods available to be sold. These are essentially products that are still in stock that have not been bought yet. And you guys can find inventory on the current asset section of the balance sheet. Check this out, you guys. Companies will really try to be sneaky when their sales are down. They'll make tons of product and not be able to sell it, so what they'll do is just add it to the inventory section to make it seem like they're good when they're really not. When inventory is high compared to years prior, this typically means that there's a problem. Remember, you guys, high inventory is a red flag that a company's having a hard time selling products. So, the next term on today's video is PPE, or property, plant, and equipment. Property, plant, and equipment are fixed, long-term assets that a company cannot liquidate right away. Property, plant, and equipment are always physical assets that can be touched, like real estate or company equipment, for example. A steady growing property, plant, and equipment on the balance sheet is a good sign for me, since it lets me know that a company is confident over their long-term future. Now, for the last term of the asset section on the balance sheet, Goodwill. Goodwill are the intangible assets of a company, or assets that we cannot touch. Examples of this are a company's brand, their name, or their recognition. Something like Nike's brand recognition would be an example of goodwill. It's not really a section that I personally look into all that much, but it is good to know about nonetheless. My bad, you guys, I had to finish the video off in the room tonight. It was getting too windy outside and it was starting to affect the audio. And before we get to the liability section, I would really appreciate it if you guys could leave today's video with a quick thumbs up. It really helps the channel grow and get recommended to other young investors as well. So thank you guys, I appreciate all of you. And without further ado, let's get into the liability section of today's video. And the very first liability for today's video is accounts payable. Accounts payable are current liabilities for a company that are going to be paid in the near future. These are essentially the opposite of accounts receivable. Let's say, for example purposes, I have a company that puts in an order to buy 100 Nike Air Forces. And as a result of that, I agree with Nike that I got to pay up for the product in 90 days. That would now be an account payable for my company. A steady growing accounts payable is considered normal for me personally. A red flag would be if the number just goes up drastically. And so, that's accounts payable. The next up on our list is accrued expenses. Accrued expenses are just about the same thing as accounts payable. Accrued expenses are essentially liabilities that have been mounted on top of each other that need to get paid. And the major difference between accounts payable and accrued expenses is that accrued expenses typically need to be paid within a year of the day that the transaction was made, whilst accounts payable are paid within 30 to 90 days. I personally look at these two. I don't like to see no crazy spikes, just steady numbers. So, next up, short-term borrowings. Short-term borrowings are essentially short-term debt. Examples of these are short-term bank loans and things like lease payments for property or office space. This one is definitely straightforward compared to the other ones, but it is still important nonetheless. And so, next up on the list, the other side of the spectrum to short-term debt, long-term debt. So long-term debt are essentially liabilities from a company that need to be paid after a year. Examples of these are bonds, long-term loans, and things like that. This is another one to definitely take into account. A major spike in long-term debt could definitely be a red flag. Sometimes businesses can be struggling financially, so they turn to something like debt, for example, to get by on dividend payments, which is not a good sign. Like I mentioned earlier, a major spike in long-term debt could definitely be a red flag. And I also wanted to let you guys know this. Short-term debts need to be paid within a year, and long-term debts need to be paid after a year. I figured that this was a good thing to point out for you guys. And so, last but not least, retained earnings. This is essentially profits that a company has kept to grow or expand the business or pay down something like debt, for example. And so, with that, I just wanted to quickly say thank you guys for sticking with me all the way to the end. I really hope you guys enjoyed and found the content valuable. I'm trying to make seemingly complicated topics understandable and basic for everybody. There's really no reason to make things more complicated than they already need to be. So thank you guys once again, and don't forget to like and subscribe to the channel if you haven't already. I drop gem-filled videos weekly for you guys. And so, with that being said, beat the odds and do the numbers. I'll catch you guys on the next one. Peace.